Hello, I'm Scott Danner, CEO of Freedom Street Partners, and I'm really blessed and lucky today to have Bryce Gill with First Trust. Bryce is on the economics team at First Trust, working daily with their chief economist, Brian Westbury. And if you haven't followed Brian or his Monday Morning Outlook, which Bryce is directly responsible for making sure is out and delivered to everybody and the information is right, it's just a phenomenal team, a phenomenal economist. Brian's someone that I've followed in my career for a long time, and I respect First Trust. Many of our clients utilize their services and products, and I just thought it would be a great idea to bring Bryce on to give us a pulse of what's going on in the world around us. And Bryce is in Austin, Texas right now, so we are doing the best we can with the timing that we have. There's ice and broken pipes everywhere around Bryce, but he's still on here with me today. So Bryce, I'm going to turn it over to you. I'd love for you to be able to do your presentation, and then we can follow up with a couple of questions and answers. And then this will be a video recording that goes out to clients and different people that follow us on social media. So very grateful for your time. Thanks so much for being with me.
Yeah, well, hey, absolutely. Thanks for having me, Scott. It's great to be with you. Thanks to your viewers, whoever's watching it in the future. Hopefully you find some useful information in this presentation today. I guess the first thing to start off with is that I feel a lot better today coming and doing a presentation, because over the past few months, I've kind of been, Dr. Doom, showing up on Zoom meetings, telling everybody, hey, coronavirus is horrible. It's causing all kinds of problems with the economy. We're seeing the recovery slow down and things like that. But something is really, over the past month, and really there's no real scientific consensus even about it, but cases have just absolutely dropped off a cliff. COVID data across the board is getting universally better. It's not just one state or one region of the US. Something like 45 out of the 50 states are seeing cases fall. It's really setting us up, along with the vaccinations and things that we're doing, for what I think is going to be a mini economic boom in the spring. And I'm kind of looking at the April, May kind of time frame when I think we're going to really see things start to reaccelerate. But from what I can tell, and obviously there's always a chance that some kind of new variant of coronavirus emerges, or some other new black swan event happens, right? I'm down here in Austin, Texas. We have the most snow we've ever had since, I think, 1894. So it's been a crazy couple of years. Obviously, a lot of crazy things keep happening, but I think broadly speaking, a lot of the data is pointing towards a pretty positive year in 2021. So with that, I'll go ahead and share some slides, and we can kind of walk through the data and kind of the thought process behind why we're optimistic for the year ahead.
That's great.
All right, so I talked a little bit about COVID-19 data, and I think it's good to just kind of review where we are. So I've got the case curves here. The blue chart parts of the chart is daily COVID-19 cases, and then the orange is COVID-19 deaths. And you can really see that since January, about mid-January, we've really seen cases absolutely collapse. I mean, we're down something like 65% from the peak. It doesn't look like it's slowing down whatsoever. We've been seeing cases fall for over a month now. And really, this has surprised a lot of people. Like I said, most of the experts were saying that, hey, post the holidays, when people are getting together, we're really going to see a huge surge in cases. We've heard a lot about these new variants from, South Africa and other places, and how they're much more transmissive, and that's going to cause, a big surge in cases. And instead, we've seen cases absolutely collapse. And, what's really interesting to me is that, in prior kind of waves, you'd see cases go up and then come down in kind of a shallow increase and a shallow decrease. This time around, we've seen cases just absolutely collapse. So it looks to me that, maybe seasonality is having something to do with it, right? We're kind of getting through the winter months when we know things are the worst. Obviously, vaccinations are a big part of this. We're doing about 1.7 million vaccinations a day. It's increasing every single day. So we're vaccinating a lot more people. That's certainly helping with transmission. But I think a big part of the conversation is being left behind when you kind of look at, mainstream news sources about why this is happening. First of all, if they're even covering it, I don't even see, positive news about cases dropping if you turn on, CNBC or, CNN or something like that. But what I really think is going on here is I think we're getting close to the herd immunity threshold. So if your viewers aren't familiar with this term, herd immunity basically means a certain threshold of the population that needs to have antibodies to a virus in order for transmission to break down. And that's kind of generally believed to be around 60 to 70% of the population needs to have antibodies for transmission to break down. And then hopefully this pandemic is from that point forward kind of in the rearview mirror. So what we've typically heard is that, hey, we need to vaccinate 70% of the population, right? We need to vaccinate everybody to get to that threshold. And if you look at how long that's going to take, I mean, we're talking about probably the fall before we're able to vaccinate that many people. And that's if, 70% of the US population even wants to get the vaccine, right? So, but I think it's wrong to just focus on vaccines because, this pandemic has been raging for nearly a year now. It's been endemic in US society. And what that means is that, a huge portion of the population has already been infected by COVID-19. And we know that prior infection, gives you pretty strong immunity. So, the scientific consensus is that basically immunity from prior infection lasts about 3 to 6 months. But, I think that that's actually underselling it because if you look worldwide, we've had about 120 million confirmed cases of COVID-19, but, we've only had about 45 to 50 cases of confirmed reinfection where someone had COVID, they got past it, and then were infected by it again. So, right. This pandemic's been going on now longer than a year. So, if prior infection only granted about 6 months of immunity, we should be seeing tens of thousands of reinfections, and they just aren't happening. So that's really kind of a big silver lining because that means a huge portion of the U.S. population already has antibodies that are going to contribute to immunity. So that's what I've kind of tried to lay out here, where you got the blue parts of the bars here is just confirmed positive tests. That's how many people have gone and gotten a PCR test. It's come up positive, and we know they have the virus. So that's about 26 million, 27 million people in the U.S. And then what I've added here in the middle, and this is something I don't think a lot of people are familiar with, is what the CDC estimates the additional infections in the United States are. So, the positive cases that we see on the daily case curve are actually a severe underestimate of how many people are getting COVID-19, because the CDC says that basically for every one person that tests positive, there's probably 3 more that have had the virus and were either asymptomatic or they just never went in and got that official PCR test. So you add that on top of there, and then the vaccines are here in gray. And you put all 3 of these things together, confirmed tests, the estimate of additional infections in the US, and then the vaccinations that we've done, and we're at about 40% of the US population has antibodies for COVID-19. And I think that this is the big reason why cases are just absolutely dropping off a cliff. One is people are still in their houses and it's cold and we're not, out, socializing as much as we will be in the summertime and things like that. But we had cases rising all through the winter. So it has to be something other than just cold weather. And I really think what it is that we're starting to get to that threshold where, the pre-existing immunity in the population is causing cases to just drop off a cliff. So that, along with, vaccinations that we're doing, if you kind of project forward the amount of vaccinations that we're doing, it looks like to me we'll be at that 60 to 70% threshold around mid-April. And maybe early May. So I've been telling people that, herd immunity is a lot closer than I think a lot of people realize. And the reason why, everybody's estimates are kind of in the fall or the winter of 2021 is because they're only looking at vaccinations, and that leaves out a huge picture or a huge part of the picture when you're talking about herd immunity. So I think it's probably closer than a lot of people expect. And that's why I'm kind of looking at, again, I said April's the kind of time frame that we're estimating. And that's why I think we're really going to see economic activity start to jump as we get into the spring and the summer, because that's when we'll have, kind of a herd immunity threshold being hit. At the same time, vaccinations are going to be ramped up. Warmer weather we know is good to kind of combat the spread of the virus. So a lot of different things are going to come together and really hopefully help us put this pandemic behind us.
Yeah, Bryce, something that's really interesting just on that slide, briefly, you don't have to go back either, is I spoke to the majority of our clients in the beginning of January through the month of January. And I was astonished at how many people prior to that had said they wouldn't get vaccinated. And through January, were all either vaccinated, getting vaccinated, or in line to get vaccinated. And so I think the public opinion and the thought process has adjusted a little bit. And we might see even more of an expedited number because of the fact that there was a lot of tallying a big chunk of America that refused to do it. And I don't know that that's as existent. People are really ready to get out. They are really ready to go back to living. As we talked about beforehand. So that's a great slide. I appreciate it. I'll let you move on, but I just thought that was a good point. It was an interesting dynamic that I've noticed in the last month.
Yeah, and actually, there's a lot of good survey data on that exact kind of point where it looks at, vaccine hesitancy is kind of a term that people use. But, it started out about 50% of the population said, hey, we're not really interested in getting this. And now that percentage has declined significantly. So people are definitely becoming more, they're less concerned about the vaccine, obviously. And it's because their friends and their relatives are getting it. And they're seeing that nothing, significantly negative is happening from it.
Yep.
So, I kind of talked about in the opening how I was Dr. Doom, and there was a lot of bad economic data as we were kind of going through, November and December of last year. And this is one of the charts that I was looking at when I was, kind of making those conclusions. And this has been one of my favorite charts throughout the pandemic. This is U.S. open table seated restaurant diners. And the reason I love this chart is because, this is daily data, so it's high frequency, and it focuses specifically on the hardest hit sector in the U.S. economy, which is restaurants and bars. I think a lot of people are familiar with open table, right? You make reservations at restaurants through it.
Yep.
And it kind of helps restaurants manage their customer flow and things like that. But what you can see here is that, early on in the pandemic, we see this absolute collapse, negative 100% from a year ago. Everybody was locked down, right? We had never done that before, but no one was going to a restaurant early on in the pandemic. And really what we saw is, throughout the summer, even with the second wave, we saw, a little bit of a plateau in activity, but pretty much a consistent recovery up until around October, when we really saw this measure roll over for the first time and really start deteriorating pretty quickly. And a lot of this, had to do with, first of all, during the third wave of cases in the U.S., we reimposed lockdowns in a lot of different places around the country. So that's going to hurt restaurants, obviously. But a big part of it, too, is that, in the summertime, we were able to get creative, right? We could use patios and we could, use the outdoors and still maintain some kind of, customer base at a lot of these restaurants. In the wintertime, in Chicago or New York, nobody, and I've seen videos of people actually eating out on patios in those places on social media, but obviously, it's a much less viable thing. So we were seeing measures like this deteriorate pretty consistently, and a lot of people were worried about, a possibility of a double dip recession. Now we ended up getting, Q4 data on GDP, and we saw GDP grow all throughout the third wave of cases in the U.S. It's really been impressive to me in general, the U.S. economy's rebound throughout the pandemic, even with the second and the third wave in general. But, what's really kind of a positive for me from looking at this chart is that, as of the end of December, it looks like this measure is basically bottomed out, and we've seen consistent gains throughout the past couple of months here. So it looks like the beleaguered restaurant sector has, once again kind of hit bottom and has begun to recover again. So there was no decline like we saw early on in the pandemic, but the good news is that, if the worst hit sector is beginning to recover again, then a lot of the headwinds to the U.S. economy in general are also probably disappearing as well. So this is good news because leisure and hospitality is by far, the worst hit industry in the U.S. And it's the big reason why we've seen things like job growth level out. So what I've got here is U.S. non-farm employment. It's basically a measure of the total number of employed people in the U.S. So you can see early on, we had about 150 million people employed in the U.S. We lost like 23 million jobs in 2 months, which is that is Great Depression territory. I mean, there's no other way to really describe it. And it's why everybody was scared to death about the economy back in March and April. I mean, things were falling apart extremely quickly. But the good news is that since then, you can see here the job gains over time. We've basically seen the U.S. gain back about 55% of those jobs since the decline in March and April. But really what's kind of worried people is that, if you look at this chart, early on, we were gaining jobs back really quickly. And then over the past couple of months, we're basically flatlined. Again, with 9 million jobs to kind of gain back to get to just pre-pandemic levels, we've still got a long way to go on the labor market to get back to where we were. And if you look at just jobs being leveled off here, it's going to take a long ways to get back to that point. But I think really, again, as we kind of look forward towards March and April, spring and summer in general, and we're able to continue to roll back pandemic restrictions, we're able to kind of return to normalcy. I think you're really going to see this job measure start to reaccelerate in the spring and the summer as we're able to hire back a lot of those leisure and hospitality people that were still unable to find new employment.
Right.
Another big part of this too is that schools in the U.S. need to reopen in order for jobs to fully recover, because women disproportionately have dropped out of the labor force in the past year, and it looks like they're staying home to basically help their children with school or take care of the kids in general so far during the pandemic. And obviously, if the kids can't go back to school, a lot of these working parents are also not going to be able to go back out and get a new job. So I'd say those are the two big things we need to see is just cases continue to decline, vaccinations continue, and schools reopening. And those two things, if they happen, I think we're really going to see a boom in employment in the spring and the summer. And we're estimating that about 6 million of the 9 million jobs get gained back in 2021. So this year, that'll be the biggest year of job growth in U.S. history. And I think honestly that might be a little too pessimistic. I think we're going to have a very strong year of job growth in 2021.
Yeah, Bryce, it's interesting to me that the other thing that we've gone through is there's been a transition of industries. I reorganized the apps on my new iPhone that I got the other day. And in doing so, I created a new category called food. And it's Grubhub and DoorDash and Uber Eats and all the local restaurants around that I can actually order from. This is an entirely new industry, something that's been around but hasn't popped. And I think there's so many others of those that are in transition, which are not even a part of the dynamic that we'll see. I mean, there's so many new entrepreneurial investments coming in the future that seems to make me excited, because there is a change and a transition. And like most transitions, it's slow in the beginning, but then it creates a lot of other opportunities.
Yeah, no, I absolutely agree. And, places like Amazon and Grubhub and these delivery services and things like that have been a big part of the jobs rebound that we've seen so far. They've come in and employed massive numbers of people. Amazon alone, I think, hired something like 550,000 people in 2020 alone. That's something like a 60% increase in employment for Amazon in 1 year. I don't think a business has ever really even done that in the past. So it is staggering, but a lot of these companies have come in and really filled in the gaps as we kind of tried to navigate our way through this pandemic. And yes, I agree. There's, the opportunities for skillful entrepreneurs, I think, has never been better in the U.S. And if you look at something like the Census Bureau, for example, tracks business applications, and business applications are the strongest they've been in decades. With even during the pandemic and kind of the negative mood around the country, entrepreneurs are still coming in and looking for opportunities, and they're going to be the ones that continue to drive job growth in 2021. So, even though we've had a pretty good recovery throughout this pandemic, I think it's important to point out that the recovery has been uneven across the U.S. And the way I'm going to kind of try and point that out is just looking at December unemployment rates with various U.S. states. So I've got the U.S. there in orange. That's kind of the median across the country. And then you can see, various states that have done better, like Florida, Georgia, and Indiana, versus states that have done worse, like California, New York, and Connecticut. And a lot of this has to do with just the severity of pandemic restrictions and lockdowns, right? Florida and Georgia have pushed forward with reopening their economies since the summertime, while California and New York have broadly remained, pretty locked down. And you can see the difference there in unemployment rates. And really my kind of worries here is that the economic scarring from staying closed, it's kind of like when you get like surgery and you're in a hospital bed. But well, the longer you're in there and you're not moving your arms or your legs, your muscles atrophy over time. And it's pretty similar with the economy, where the longer things are closed down, the more businesses disappear. It's going to take a longer time to recover because those economic muscles are atrophying. It's going to take a new entrepreneur, like we were just talking about, a new business permit. You have to go out and interview people. You're going to have to get a new bank loan. So a lot of these things are going to take time, and it'll be interesting to see, the catch-up growth in a lot of these states that have kind of lagged behind so far.
Yeah, you're going to have to evaluate, Bryce, if you want to live in a place that doesn't allow you to operate as a free human being. I mean, at the end of the day, I'm not aware of the statistics or the decision making that goes into these things at the level that obviously the policy and ideologies were created. But if I'm living in California, but I could live in Florida and do the very same business I could do at any point in time, I can get similar weather and sunlight, and I can operate at a much freer level. I think we're also going to see a little bit of an exodus from some of the states that aren't allowing these things to happen. And that might change the face of business. I mean, we've seen a ton. You're in Austin, Texas. The amount of businesses that have moved from California to Austin, large businesses, are astronomical. And I think that's a unique thing that's happening that has to do with this uneven recovery as well.
Yeah, no, it would be one thing if we looked empirically and lockdowns seem to have, caused significantly better outcomes in places that instituted them. But really, when you look at it, so for example, you compare Florida to California, they've been kind of two opposite sides of the coin throughout the pandemic. Well, Florida and California have very similar levels of, if you look at population adjusted deaths. So, and with Florida being much older population, having more people over 65 plus as a percent of the population than California, it's not clear to me, or really, I think anybody that kind of has a very open mind looking at these pandemic restrictions, if there's really any kind of positive benefit coming from them, whatsoever. And, the other thing you mentioned with people moving around in the United States, that's another thing that, it's really jump-started, I guess, relocations around the country, with people moving like crazy out of California, out of New York, out of Illinois, and heading to places like Florida and Texas. And, now I guess all these California people down here in Austin, I don't know if they're going to want to stay after this polar vortex storm that we just had, but, I really haven't seen population movements like this in a long you and it seems like a lot of it has to do with freedom and kind of how much are you allowed to do during this pandemic. I think these measures have really caused a lot of people to reevaluate where they live. So things like the Census Bureau and U.S. Postal Service, if you look at change of address forms and things like that, we're seeing an absolute flood of people and businesses out of certain states into others. And it's really kind of a new, diaspora. I haven't really seen anything like it in U.S. history since maybe, the big migration from the South to the northern cities to work in places like Detroit and the auto plants and things like that. So that'll be a really interesting thing to see going forward, kind of the economic implications of that.
Yeah, it's almost a revolution. I mean, when you look at things like that, the other thing that I think is really important is take business out of it, take the numbers out of it, and just look at the family dynamic. I've been extremely blessed to have my mom and dad and my sister and my brother and everybody pretty close. So even by going through the standard operating procedures of the rules and regulations of not having huge parties, not doing anything, we've still been able to function as a family. And being clear across the country and not being able to fly back and forth, for me, if I were in California right now, would be a major indicator that I'd want to move back home. And Zoom has created the ability for me to do my job from anywhere in the world, and the same for so many other people. So I love the data. I think it's so cool to look at the rates. California and Florida are interesting to me because vitamin D deficiency has also been a major thing that hasn't been talked about. And Florida and California both have similar vitamin D opportunities versus other places where I could say New York is, man, it's cold and it's not sunny right now. And it's not the same as being in Miami, Florida today. So these are definitely more active individuals in Florida. I mean, it's just so unique in California, but looking at the data between them, I think we'll learn a lot from these types of things. And the more data we get, the better we'll be able to create new opportunities in the future. And I think it's great. Great slide.
Okay, so, this has been, a recession unlike anything that I've really seen because, the way that we've responded to it at the federal level is kind of unprecedented. And this is kind of a slide to try to demonstrate how different it's been. So what I've got here is retail sales in blue and personal income in orange in the United States. So if you look back to 08, 09, it's kind of a typical example of a recession where, unemployment starts to rise. That leads to a decline in personal income. Obviously, that leads to a big decline in retail sales as well. But if you come over to 2020 and look what happened, despite us losing orders of magnitude more people, job-wise than in 2008 and 2020, personal income never fell. It actually surged in 2020. And the reason is because, we stepped in federal government-wise with income replacement, where we're sending out boosted unemployment benefits. We're sending out stimulus checks like crazy. We just passed another one. It looks like we're going to pass another 1.9 trillion in stimulus. That's probably going to have checks as well. So the federal government this time around has really stepped in and just sent cash to U.S. citizens in a way it never has before. And it looks so far like it's been pretty successful with, retail sales does a full V-shaped recovery. It's been a pretty strong recovery in the United States in general. We've outpaced places like Europe. But, kind of the flip side, and I always tell people, it's crazy to think about, but the United States in aggregate, and obviously there's winners and losers, right? When you're talking about a country of 320 million people, but the United States in aggregate got a raise in 2020 in dollar terms, which is, a pretty, crazy result. And it's the only recession that I've ever heard of where, things like net worth went up for basically every household in the U.S. And that's because of housing prices and stock prices and things like that. So, it really is a recession unlike we've ever seen. And, we've been able to kind of forestall any kind of financial crisis because people are still able to make their mortgage payments or their car payments and things like that. But the flip side of it is that people are much more worried this time around about inflation because the way that we're basically paying for a lot of this federal spending to support incomes is that, the Federal Reserve is printing money and they're buying U.S. Treasury bonds. And then the U.S. government is in turn giving that cash out to consumers. So a lot of this is being done with newly created money. And we've really never done anything like this before. So after 08, 09, people were worried about inflation. And at First Trust, we told them, hey, listen, it's very unlikely that we see any kind of ramp up in inflation after this, because at the time we were giving money directly to banks, which were just using them in their capital ratios. They were just putting that money in a vault and sitting on it. This time around, we're handing out money directly to consumers. It's going straight into their bank accounts. And really the only thing that's keeping, an increase in prices from happening is that, broadly speaking, people have just been saving a lot of this money, more so than really any time in U.S. history. So this is the U.S. personal savings rate back to 1959. That's just as far back as the Bureau of Economic Analysis has it. But you can see, again, as we kind of head into 2020, the personal savings rate absolutely skyrockets during the first round of stimulus, and people are worried about the future, so they're saving more because of that. We're also not able to spend money on what we would normally spend money on, right? Going to a football game or going to a restaurant or whatever it is. So people have squirreled away more money than at any other time in U.S. history during the pandemic. And if you kind of do the back of the envelope math on it, it ends up being about $2.8 trillion of savings in 2020. And that is a huge chunk of pent-up consumer spending power that is basically waiting for consumer confidence to come back, for fears about the virus to disappear, and a lot of these lockdowns to end. And this is a big reason why I think we're going to see a huge pop in economic activity in the spring and the summer, because this money has not disappeared. People are going to be excited to get out of their houses. They're going to be excited to get back to normal. And I think we're going to see a lot of this money re-enter the economy in a relatively short period of time. So that's going to be really great for, like I was talking about hiring earlier, that's a huge increase in demand. It means there's going to be a lot more people being rehired to meet that demand. It's going to be great for business earnings in general. It should continue to power earnings higher in 2021. But the flip side is that it's very likely to drive up prices in general. So we're already kind of seeing that if you look at different commodity prices in the US, especially industrial commodities, things like copper and tin and nickel and lithium, lumber for housing, steel. All these things are up pretty significantly over the past several months. And I think a lot of it has to do with, people looking forward and basically seeing this big flood of money ready to re-enter the U.S. economy in 2021. So kind of the best historical example that I have of this is, after World War II, we were really winding down the defense industry. We had millions of soldiers coming back from abroad, and people were very worried that, hey, we have nowhere to employ these guys. We're basically going to see a Great Depression return. And what they hadn't factored in was that, throughout World War II, there was significant amount of rationing due to the war. So you weren't able to buy a car, you weren't able to get silk for your wedding dress, you couldn't buy sugar for your coffee. And that led to people to save a very large amount of their pay. And basically, as World War II ended and a lot of these rationing programs ended, we saw a huge amount of saved money re-enter the U.S. economy in a relatively short period of time. And that gave us a very strong period of economic growth in the 1950s. And I don't think that it's necessarily going to be to that degree this time around, but I think we're going to see a similar situation. And I think this saved money is really going to be a big part of the picture in 2021 and should cause pretty strong economic growth and recovery in the labor market. So this kind of example, I was talking about how this time around, what we did with the Federal Reserve and distributing money was different than 08, 09. This is the M2 money supply. So it's what's called high-powered money. It's basically money in checking and savings accounts that are likely to be spent commercially on different things. So if you look at 08, 09, even with all the quantitative easing and the Fed expanding its balance sheet and things like that, there's really no notable increase from a historical perspective in the money supply. This time around, again in 2020, it's what we see on a lot of different charts where things are just completely an order of magnitude different from history. The money supply has expanded extremely rapidly, and like I mentioned with that savings, I think when we see those savings re-enter the economy, that's when you're really going to start to see headline measures of inflation like the consumer price index start to increase. And spring and the summer is really where I think we start to see that happen. All right, so last thing I want to talk about here is our outlook for the stock market at First Trust. And what I've got here is just kind of a track record so you guys can see how we've done over time. We've got the dots with all our different forecasts over the years, and then obviously the indexes themselves. So you can kind of see, how we've done. And this year we're looking for the S&P 500 to end at 4,200 and the Dow to end at 35,000. It's about a 15% gain year over year. And really, there's a couple things that go into this forecast. So we use what's called the capitalized profits model, and we're looking at, overall corporate earnings, and we're discounting them by the 10-year treasury. And it's important to include interest rates in your stock market valuations, because they're a very fundamental component of valuation. So a lot of people just use an EPS forecast and then they apply a multiple to it. We're using the 10-year itself, and I think that gives us a much better estimate than a lot of other people. So we think interest rates are likely to stay low, even if we see the consumer price index increase or other measures of inflation start to increase. The Federal Reserve has made it pretty clear that, hey, they're going to stay at 0% probably until 2023, even if inflation accelerates, because they really want to see the labor market fully recover before there's any kind of interest rate hikes. So I think the Fed remains basically at 0. And while we will probably see continuing upward movement on the 10-year Treasury, we've already seen it, the yield on the 10-year start to rise. We're estimating that it ends 2021 at about 1.5%. So stays pretty, overall pretty depressed, and that should keep multiples high. And then really what's going to be going on behind the scenes is that U.S. corporate profits are going to continue to recover. So what I've got here is U.S. pre-tax corporate profits. And, obviously with the Biden administration in there and in control of the House and the Senate, it's likely we see some kind of corporate tax increase. So, keep that in mind. I don't think it's going to happen until 2022, as we, they're going to basically give us some time to crawl our way out of the hole from this pandemic. But really, again, I think it's kind of interesting comparing the 08, 09 to the recession that we're having now, where 2008, 2009, profits are falling for years before we even hit that financial crisis. They take several more years to recover after that to their pre-recession levels. This time around, corporate profits absolutely plunge in Q1 and Q2, and this data is only through Q3 of 2020. Corporate profits had already made a full V-shaped recovery by Q3, and this is because businesses have been able to cut costs and keep their profit margins elevated by basically eliminating things like business travel, eliminating brick and mortar locations, office space, all these things. And I think as we look into the future, you look at different estimates for earnings per share in the S&P 500, or even just estimates of earnings in general rising. I think we're going to see a pretty strong year in 2021, and a lot of that's going to be all that saved up money that I mentioned earlier. A lot of that's going to wind up in corporate earnings. So I think the outlook remains really great for corporate profits in 2021. Like I said, I think we're going to have a pretty good boom in economic activity in the spring and the summer that continues through the rest of the year. And whereas we really saw the stock market do well in 2020 because a lot of big tech companies outperformed, and really the market itself did well because multiples were rising. I think in 2021, basically what we're going to see is the market powered higher by rising earnings. So with that, I'll go ahead and turn it back over to you, Scott, and we can do some question and answer.
Sure. Kind of a return to fundamentals, if you will. Some of the things I think everybody's assumption was everything in the markets was amazing last year. And it really came down to a select group of companies that were driving that success. And if you just look at the difference between growth and value in the year, it was so significant, and you're starting to see that gap close. We're getting a lot of questions from clients that because it feels good, and it's starting to actually, you're hearing a lot of people talk about stocks. Kids are getting invested in stocks, interested in stocks, Robinhood, all these things there's almost a whole new generation of interest, which I think is infectious in a positive way. I mean, that's definitely driving people to feel more comfort, something that a lot of people lost in the 1999 to 2003 timeframe because they started to put all their effort into housing and different things, but they're almost gaining back that confidence. When we look at the numbers that First Trust is saying, I'll get to the question here. The question is, is it too good to be true? Is it a timeline where, yes, we see things coming out, yes, we see a boom, but when you start to look at some of the growth that we've seen over the last decade, do clients need to feel concerned?
Yeah, so I mean, I think we're in for a couple of years here of above trend economic growth, just as we kind of catch up and things like that. As far as kind of, is the stock market too good to be true? I would say the biggest thing to focus on, and the reason why the market, did so well again, is that interest rates absolutely collapsed. And interest rates, I think, are the biggest kind of open question for 2021, because if interest rates stay low like we expect them to, they're 1.5%, 2%, the market's going to do well, and it's going to do well off the back of rising corporate earnings. But if interest rates, we see inflation accelerate, we see the Fed respond to that in a big way, or the bond vigilantes finally show up after the past decade of being in hiding, and the 10-year Treasury rate starts to explode. I think we basically see multiples come down pretty significantly on things like the S&P 500. So that's where I would say my biggest concern is. But the flip side of it is that the United States is the world reserve currency. There's no one that's really can compete with us. If Europe was one unified super state and they could issue debt like we can, maybe they could compete. Nobody wants to buy Chinese debt. They don't protect property rights. Billionaires disappear there every day. So the reality is that there's just nobody else to really fill the role that the US dollar fills right now. Without a big crisis in confidence and the reserve currency status disappearing, I don't see, interest rates absolutely exploding over a short period of time. Now, a couple of things maybe could change that. Maybe if, we start doing something like a universal basic income, or we do, some other very large kind of entitlement program at the federal level that we're financing purely off of printed Federal Reserve money, I think that could cause investors around the world to be much more concerned about the dollar. But as it stands now with a 50-50 split in the Senate, the reality is that policies like that are just not going to pass. So I think over the next couple of years, we're probably in for just kind of a broad coast higher. And then I think, we'll need to, basically look at dangers around new economic policy and kind of, worries about the labor market and things like that after we crawl our way out of the pandemic hole. But, anything is going to feel better than 2020. But I think, 2021, we're going to make up a lot of the ground that we lost.
Yeah. Listen, I think you did a phenomenal job today, Bryce. I asked questions throughout, so I think that was a much cleaner way to go through the presentation. It was we were able to kind of discuss some of the slides, and I'm very appreciative. First Trust is a great partner of ours and a wonderful advocate for the average investor and the clients out there that we serve every day. And the positive news is something that's often hard to find. And I think that while Brian Westbury he jokes about being the perma bear as what he's called, he just says it how it is. And I think your team in general does that. And we're very grateful for that message and that messaging, because it's something that's very difficult to find right now consistently without some level of bias. And, we all want things to be good. But I think that the data we're looking at and the information you provided today was phenomenal. I hope that you thaw out a little bit in Austin and it gets to be a little bit more Austin-like. This is not why you wanted to live there. Otherwise, you would have chosen Chicago as the place to live.
Yeah, that's where I'm from.
Okay, right. So I've been to Chicago multiple times. Awesome city. Not awesome right now in the cold. So anyway, I'm Scott Danner with Bryce Gill out of First Trust. Thank you so much for joining me, and hopefully everybody enjoyed the presentation today.
Yep. Thanks a lot, Scott. We appreciate you having us.